Hello and welcome to Pro Trader Strategies Market Commentary for Thursday, February the 22nd. My name is Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, we're here to teach you some different strategies that you can implement into your portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters. I don't know what's in your portfolios, and therefore what I'm doing could be counterintuitive to what you are already doing. Please remember that past performance of any trading system or methodology is not necessarily indicative of future results. All right, having all that out of the way, let's get it on with some economic data across the pond. We do have a lot of Fed governor speaking. As a matter of fact, overnight we had Quarles speaking. He's an FOMC member. But then we got, in Great Britain, we got preliminary business investment came in unchanged, expected to be 0.5% increase, although they did revise last month's number up from 0.2 to 0.5%, so a 3-point increase, kind of offsetting that a little bit. And then we also got the retail sales out of Canada came in at a negative 1.8%, expected to be a positive 0.1%, and they did revise last month's number up slightly by a tenth of a percent. So it's not really making up for that massive miss on the Canadian retail sales number. So that was the core retail sales. And then retail sales came in at negative 0.8%, expected to be unchanged. Again, they revised last month's number up by a tenth. Still not very good out of the Canadian sector. I usually don't talk about those numbers, but those were pretty big misses. I'll talk about the big hits and the big misses. And then we got natural gas storages came in at 124 billion cubic feet, expected to be negative 121 billion cubic feet. So that's a draw of 124 billion cubic feet. And then we got natural, which is due mostly to the cold weather we've been seeing across the Midwest and the East Coast. And then crude oil inventories came in at a drawdown of 1.6 million barrels, expected to be a build of 2.2 million barrels. So a big draw on crude oil. Now, usually I talk about how these crude oil numbers is because you're moving one basket to the next. You're moving it from the crude oil and distilling that into gasoline and distillates, and that's your byproducts. But those have been really building. So it's been just kind of shuffling the shells, if you will, moving the shells around, the shell game. But what we're seeing right now with this drawdown of 1.61 million barrels is that we didn't see the build in gasoline like we were expecting. We were expecting a build in gasoline to be 1.3 million barrels. It came in at 261,000 barrels. And distillates came in at a drawdown of 2.4 million barrels, expected to be a drawdown of 1.1 million barrels. Cushing also a draw of 2.6 million barrels. Now, production, we've been talking about this. They're going to be starting to cut back a little bit on production because they are shutting down some of these refineries for yearly maintenance. So we're going to see some production cutbacks, which we expected. But that would expect to see then have crude oil start to rise. We're not really seeing that. We're really seeing a lot of distillates moving, which is good for the manufacturing sector. Gasoline not building as much because people are driving, so low gas prices would be good. Anything below $3 I think is pretty nice across the United States. And then, so all of that being said, we're starting to see some demand for these products, which is good for the overall economy. Not really showing up in the data like we'd like to see it as of lately, but we are seeing it in this data for the crude oil inventories. And with that being said, crude oil is up over $1 right now. It is testing the trend channel here. Yesterday, we were right settling on that 50-day moving average. I talked about that being resistance. We got a lot of resistance areas to get through to get that bullish move back in. And I think we're starting to see that today with the move in crude oil up $1 and trying to get back into that trend channel. We'd like to see that for the bulls. Anyway, on to gold futures, bouncing off the 78 Fibonacci level. Tried to test it yesterday. Came just shy of that, but today we came in and slammed down to test that. You know, the inflation trade isn't quite dead yet, I guess. We're starting to see crude oil try to kind of grasp its way into positive territory, just down 70 cents right now, but finding a lot of support on that 78 Fibonacci level. We've got Bitcoin. Bitcoin futures are just all over the place. You know, they cannot stay above that 10,000. Yesterday we were in that range. I talked about it. It wants to get up there, but it's just not happening. And as you can see, the 50 and the 200 moving averages are crossing, which is very bearish for Bitcoin futures. We saw that cross happen overnight. We are seeing that just bearishness come in as soon as we get below that 10,000. That's what happened last night. Starts getting below 10,000. Panic sets in for the bulls, and we are now below that 10,000 line in the sand. That's a psychological level. I don't think it really matches up necessarily to a lot of metrics right now. But that being said, in the future, I think that that is a major line in the sand that people will be battling over. And then we've got the bonds up a half a point after yesterday's big sell-off. Pretty much a profit-taking move. Once we got below this support, it's really when we started seeing that acceleration to the downside happen in the bonds. Now you're seeing that as resistance right now to the upside. So it's going to be hard to get through that. But I think it's a little overdone, despite the fact that the FOMC is talking about raising interest rates to fight off inflation. We aren't really seeing the robustness in the economy. We are starting to see some ticks of good economic data, and that needs to be carried forward. We don't want to stifle this economy as we're just starting to get this, locomotive moving. So I don't think that they want to do it necessarily 3 times, but, the Fed doesn't necessarily listen to me. Anyway, about the bonds, they are still below the 9-day moving average, so very bearish, but I think it's a little overdone. VIX coming off after trying to claw its way up higher. This morning we started out pretty bearish. Now the overall market has been rallying ever since the open. As you can see with the Dow Jones Industrial Average up over 300 points right now and very near the highs, but on the open you can see we just basically printed there and then rallied. But when you can see the overnight session with the NASDAQ, the Dow, this was looking pretty bearish. It's a very sloppy setup pattern here. It could just be, a little bit of profit taking going on. But today starting to move higher, as you can see with the Dow Jones up 300, the NASDAQ up nicely, the E-mini S&Ps up quite nicely. Coming up against this 50-day moving average here, that's going to act as resistance. It's coinciding with this 23 Fibonacci area as well. But I think that we can probably get through that. I think most of the bad news is out and away from us. Now, this is the daily chart, 30-minute bars on a daily breakdown here. Yesterday, late in the afternoon, the market just kind of fell out of bed. And I talked about I had a couple of working orders in there that got away from me in my IRA and my margin account. They ended up coming back into fruition towards the end of the day. So I got filled on a couple of things I'll talk about here in a few minutes. But as you can see, overnight inventory was getting short. And then coming into the day, those shorts all started covering and continuation into today's session with a bullish move. Feeling very inside day-ish, like I've talked about the whole week. Just really not going a whole lot, not really picking a direction. It's just been all over the place. I'm looking for it to move to the upside as I'm short a lot of puts, meaning I'm long deltas, bullish the overall markets. I've tried to add a few short deltas to my portfolio, which I'll talk about here in just a second. But with that being said, let's talk about yesterday's trades that I got into late in the day. I talked about this in the daily market commentary that I was working a few of these. And if we look at this with XOM, Exxon Mobil, in my margin account, I just went in there and sold the XOM March 72 puts for 35 cents in there. So I got that on the sell-off. I could have gotten them better had I waited a little bit, but I just had working orders in there. And then in my IRA in XOM, I did it as a defined risk strategy like I normally do and went in there and did the March 72.65 put spread. So I'm short the 72 puts, long the 65s that define that risk. Sold it for 33 cents in there. So ExxonMobil getting a nice pop today. So both those trades working out. So far, I was going to have a very short leash, and I still do have a very short leash on these. If the market starts to turn around, I'm going to be ready to pull or get out of all of my long delta short puts, if you will. So today was going to be really touch and go in the morning, but we got that bounce, that little bit of a rally. I'm still on the fence whether or not I want to keep these. It's going to be all about how this session kind of pans out, whether or not I'm going to pull those, because a lot of my stocks that I'm short puts in are better than 50% of max profit, squeezing out a little bit of extra on these right now because of my market directional assumption, and trying to squeeze back a little bit my margin account there because I had a couple of bad trades, so I'm trying to make up for those a little bit. So I'm squeezing just a little bit more out of these with a couple of these trades like that I'll talk about here in a second. But I'm getting a little ahead of myself. UPS, another trade I got on yesterday. I talked about this yesterday as well. March, sold the 99 puts, bought the 85 puts to define that risk, collected a 48-cent credit. So UPS, I think it's just overdone to the downside. I'm not really understanding why it's gotten this big of a sell-off. They did miss on earnings, but at the end of the day, Amazon and everybody else is going to push these guys higher as more and more people are buying from Amazon. So I'm bullish on UPS. I think they'll do quite well. And if they just stick here right at the point of control where the most time and volume has been spent over the last year, I'm fine with that because I'm short puts. I want that theta decay. So I'm good with that. In my IRA, I talked about the IRA trade. In my margin account with UPS, all I did was sell the March 99 puts in there for 57 cents. So looking for a bit of a pop there as well. This is just acting as a lot of support. It's kind of getting comfortable here. I think that's going to work out well for me. And then on to XRT. This is a trade that I added this morning only in my margin account. Looking for retailers to kind of slough off here. I don't think that they're going to do too well now that we're past the Christmas season or the holiday season. So I went in there and sold the March 47 calls for 35 cents. Again, trying to just neutralize my portfolio a little bit more, add some short deltas, the real reason why I did that. So if we get above at all this area here, or even this Fibonacci start to go up there and test that, I'm going to have a short leash on it and look to cover it. So that's where my out is. We get above the 23 Fibonacci level, I'm going to have a very quick itchy trigger finger and definitely pulling the trigger if we get above this 46.71 area. So that's why I picked those 47 calls. It's above those two areas of resistance for this market. So looking to play that to the downside and get out probably for around 50% of my max profit. All right, I think that's it for today. We've got on the docket for tomorrow, we've got a webinar that is going to be talking about the butterflies. And the butterflies are going to be a really great one, especially in a market like we saw in the consolidation in UPS. You could have done a long put spread in there, or long butterfly in there, or something along those lines where you expect to have a outpaced move. I'm not expecting that for UPS, and it has high implied volatility. So that's why I lean towards the selling those puts in there. So, and one other thing I forgot to talk about was Qualcomm. So let's talk about Qualcomm real quick. I'm trying to get out of this trade right now. Better than 50% of my max profit on this. And if you remember, I have on the March, short the March 55 puts in there that I originally sold for 60 cents. Right now, I'm trying to get out of those for right around 23 cents. So 50% of my max profit's right around 31 cents or so. I could get out. It's trading around 25 cents. So trying to get out, like I said, squeezing it for about an extra nickel or a dime better. So, all those pennies count. So looking for Qualcomm to make a little bit of a move higher here, and I'll probably be able to get out of those puts today. And that's it. That's all I got for you guys. Other than, if you can't take that, take it easy.